All right, future chartered accountants, welcome. If you're ready to absolutely lock down one of the most critical accounting standards for your CA inner exams, then you are in exactly the right place. Today, we're diving deep into AS-3, the cash flow statement.
Seriously, think about that. A company's profit and loss statement shows a massive 1 crore rupee profit, but they can't pay their suppliers, they can't make payroll, and eventually the whole thing just collapses. How on earth is that possible? Well, the answer lies in one simple, powerful truth. Profit is not cash. And understanding that difference, that's the entire game when it comes to AS-3.
Okay, so back to our profitable but bankrupt company. You see, the P&L account can be loaded with things that aren't actual cash, like depreciation or big sales made on credit that, well, you haven't collected the cash for yet. The cash flow statement is like a truth serum. It cuts through all that noise. It tells the real story of where the hard cash came from and where it actually went. It's the ultimate health check on a company's ability to survive.
All right, let's lay down the foundation. Getting these basic rules and definitions right is totally non-negotiable. I mean it. Every single problem you solve will depend on you knowing these fundamentals inside and out. First things first, who even needs to do this? Well, the Companies Act makes it mandatory for pretty much everyone. But, and you need to listen closely here, this is important. ICAI absolutely loves to test the exceptions. Why? Because it separates the students who've just memorized from those who truly understand. So burn these 4 into your memory. One-person company, small company, dormant company, and startup private companies. I promise you, marks are lost right here if you can't recall these specific exemptions under pressure.
The definition of cash itself is nice and straightforward, thankfully. It's basically the money you can spend this very second. So we're talking about physical notes in coins in the drawer and the money that's sitting in your current account at the bank.
Easy peasy.
Now here's where it gets a little more interesting. Cash equivalents. These aren't cash, but they're super close. Think of investments that you can turn into cash really fast with almost no risk of losing value. But here is the killer detail, the one that ICAI just loves to twist in exam questions. The maturity has to be 3 months or less from the day you bought it, not its original maturity. So if a company buys a 1-year bond that only has 2 months left until it matures, boom, it's a cash equivalent. That is a classic trap, so watch out for it.
So, what counts as a cash flow? The key takeaway is this. A cash flow only happens when the total amount of your cash and cash equivalents actually changes. If you take 1,000 rupees from your petty cash box and deposit it into your bank account, has your total cash changed? Nope. You've just moved it from your left pocket to your right pocket. That is not a cash flow.
This right here, this is the heart and soul of the statement. Every single transaction involving cash has to be sorted neatly into one of these 3 buckets, no exceptions. Mastering this sorting process is pretty much the entire key to getting the statement right.
And this table just lays it out perfectly. Think of it like this. Operating activities are your main gig, your day-to-day business that brings in revenue. Investing activities are all about buying and selling long-term stuff. Think machinery, buildings, or investments in other companies. And financing activities? That's all about how you get the money to run the show. Issuing shares to owners, taking loans from banks, and of course, paying them back.
Okay, buckle up. We are now entering what I like to call the ICA classification maze. This is where the questions get tricky, and it's honestly where marks are either won or lost. Let's break down these confusing items one by one so you don't get caught out.
Okay, stop what you're doing and really focus on this slide. This is a 5-star guaranteed exam question area. The first thing you must do when you see interest or dividends is ask, what kind of company is this? For a normal manufacturing company, paying interest on a loan is a financing cost. But for a bank, lending money is their main business. So for them, interest paid and received are both operating. AICAI will absolutely give you a question about a financial company just to test this. And notice, dividends paid is always financing, no matter what, because it's a return to the people who provided the capital.
Let's keep going with these tricky ones. The golden rule is simple. Always link the cash flow back to its source. So income tax you paid on your regular business profits, that's an operating outflow. But what about the TDS on interest you got from an investment? Well, since the interest itself is an investing inflow, the tax related to it is an investing outflow. Makes sense, right? Same logic for insurance. A claim for lost inventory relates to your day-to-day operations, so it's operating. A claim for a destroyed machine relates to a long-term asset, so it's investing. It all comes back to the source.
Okay, so we've got the what and the where. We know what the buckets are, and we know how to classify the tricky stuff.
Now let's talk about the how, the actual mechanics of putting this statement together. Now there are two ways to show your operating cash flows, the direct method and the indirect method. But let's be real. For your exams, 99% of the time, it is all about the indirect method. Why? Because it really tests your core accounting skills. It forces you to take the net profit from the P&L and reconcile it all the way back to actual cash. That's the skill the examiners want to see.
Just follow these steps religiously, in this order, and you can't go wrong. You start with your net profit before tax. Then you reverse all the non-cash stuff, like adding back depreciation. You also reverse non-operating items, like a profit on the sale of an asset. Why? Because the full cash from that sale will be shown under investing. Next, you adjust for working capital. Here's a simple rule. If a current asset goes up, your cash goes down. If a current liability goes up, your cash goes up. It's an inverse relationship. Finally, subtract the actual tax you paid, and you've got your net cash from operations.
Okay, let's talk about some special cases. These are the little details where easy marks can just vanish if you're not careful. First, you have to show gross inflows and outflows, not just the net amount. Second, and this is a huge one, non-cash transactions have absolutely no place in the cash flow statement. Issuing bonus shares, converting debentures into equity, no cash moved, so they don't go in the statement. They get disclosed separately in the notes. Please remember that.
All right, enough theory. Theory is great, but marks are scored by actually doing. So let's get our hands dirty and apply everything we've learned to some quick problems, just like the ones you'll find in your ICAI material.
Let's do a quick-fire round. Ready? Proceeds from issuing shares. That's raising funds, so it's financing. Buying machinery, long-term asset, that's investing. Cash sales, core business, that's operating. Now look at that tricky one, bank overdraft. As per AS-3, this is treated as a short-term borrowing, which makes it a financing activity. That's a great one to remember. See how these tiny little illustrations test huge concepts? Illustration 2 just hammers home that date of acquisition rule we talked about. It's all about how quickly you can get your cash back from the moment you bought it. And illustration 3 is a great reminder. The insurance claim follows the asset. Machine is an investing asset, so the cash inflow from the claim is also an investing cash flow. And bad debts written off, that's a classic non-cash expense you'd add back when using the indirect method. Okay, here we go. Let's build this thing from scratch. We're using the direct method here, just for clarity. First, we tackle operating activities. We start with cash we collected from customers, a positive $350,000. From that, we subtract the cash we paid to suppliers, for salaries, and for other overheads. That leaves us with $220,000 in cash generated from operations. We then subtract the actual income tax paid, and we land on our net cash from operating activities, $165,000.
Next up, investing and financing. Under investing, we see a big $4 lakh outflow to buy new equipment, but we got $70,000 back from selling some old stuff, giving us a net outflow of $330,000. Then for financing, we had a huge $5 lakh inflow from new shares, but that was balanced by outflows to pay back debentures, loans, and dividends. And remember what I said earlier? We have to show these gross inflows and outflows separately, don't just net them up. And now for the most satisfying part of any cash flow problem, the final reconciliation. This is your moment of truth. We take the net cash from all three activities, add them up, and find we had a net decrease in cash of $65,000 for the year. We add that to our opening cash of $80,000, and we get a closing balance of $15,000. Then you flip to the balance sheet in the question, and if it matches the closing cash balance given, you've nailed it. It's your built-in self-check in the exam hall. And that's really what this is all about. Let's go back to that first question. Now, when you look at a cash flow statement, you won't just see a bunch of numbers. You'll see the story. Is this company generating cash from its actual business? Or is it just surviving by selling off its machinery and taking on more and more debt? AS-3 gives you the power to be a true financial analyst, not just an accountant. And that's how you'll secure those marks. Good luck.